Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
KLA Corporation off to a strong start in 2026, waiting for better entry.
This article was written by Perseus Perspectives. Summary: KLA Corporation remains a hold due to an extended valuation despite strong industry momentum and robust fundamentals. KLAC benefits from hyperscaler and TSMC capex cycles, but its stock sits at the top of its historical trading range. Geopolitical risk persists, with 40% of KLAC's revenue from China, yet the current valuation, not geopolitics, drives the hold rating. Earnings momentum is strong, but risk-reward is not compelling for new positions at current levels. Introduction: KLA Corporation, KLAC, is a specialist semiconductor process control and yield management company. It exists in the universe of firms that create machines that assist the development of chips, the so-called group of firms known as wafer fabrication equipment firms, or WFE for short. The peer set includes names like Lam Research, LRCX, Applied Materials, AMAT, and ASML, to name a few key ones. This group of companies has had a simply staggering start to 2026. All of the names mentioned are up at least 25% since the start of the year at the time of my writing. I thought, given these standout moves, it would be opportune to review my thesis on KLA and examine for readers why these stocks have a fire lit under them to start the year. In my previous coverage of KLA, I issued a hold recommendation. In hindsight, given how well the stock has done, that looks like a bad call. My rationale for choosing a hold rating was the geopolitical risk associated with the stock.
KLA generates around 40% of its revenue from China, with the new president set to take office in January of 2025. And a trade tariff agenda likely. I saw significant risk to KLA and its peers from export restrictions to China. Given that AI is a technology of critical importance both for technological leadership and national security, it seemed perfectly possible to me that the provision of advanced WFE tools could be restricted to China, and indeed that risk remains on the table. I am maintaining my hold rating on KLA for today. However, my reluctance to upgrade to a buy is determined more by valuation than geopolitics at this moment. KLA is a classical cyclical compounder, a name that does very well over the longer term, but its moves have tended to be strong upswings rather than a more steady type of price action. The good news for investors is that we can be assured that this type of stock will naturally retrench and give us better entry points. I think this is a great business, but the risk-reward I don't love right at the minute, keeping KLA at hold. The food chain. It might be instructive for a moment to just give readers a high-level overview of the semiconductor food chain. So if we start with the chip design firms, here we have well-known names like NVIDIA, NVDA, AMD, and Intel, INTC. These firms design new chips with the help of tools from firms like Synopsys, SNPS, and Cadence, CDNS. The chip designs are sent off to a foundry to be manufactured. The most notable and leading foundry is, of course, TSMC, TSM. TSMC in turn needs a host of different tools to run a highly complex fabrication plant. For these, it turns to ASML for the all-important lithography or printing machines, Lam for specialist machines for processes like deposition and etching, KLA inspection and metrology, and Applied Materials for a range of things, including ion implantation. The key takeaways for readers are these: are highly complex and sophisticated companies that compete right at the cutting edge of technology in very specific domains. This is an industry that, due to its enormous complexity, has massive barriers to entry. The market structure is an oligopoly for the most part, with some domains being essentially monopolies, such as EUV lithography. This high level of sophistication and market structure has allowed all of the leading firms to generate outsized profits and stock market returns over a very long period, as they have ridden a secular wave of ever more complex semiconductor processes and designs, the end products of which power the global economy. Everything these days from smartphones to data centers to vehicles. So,
The co-integrated nature of these companies allows us to pretty accurately see that when a hyperscaler such as Amazon AMZN announces a big increase in CapEx to be spent on chips from NVIDIA and AMD, we can infer down the chain that this spending will filter through the ecosystem. Just look at TSMC's earnings from last week. What did we see? Huge increases in revenue, huge increases in profits, and a big increase in their own CapEx budget. TSMC expects to spend between $52 to $56 billion in CapEx next year, as compared to less than $30 billion in 2024. Readers can, of course, guess where that TSMC CapEx will be spent. The lion's share will go on tools from the WFE players. That, in essence, is why KLA and its peers have started the year in such fine form. Technical analysis. The potential good news for investors, ruining the thought they missed the opportunity in KLA, is the stock's historical tendency to burst quickly to the upside, only to consolidate or pull back, giving investors a chance to bite.
The below chart, I think, is quite instructive. Since the lows of March 2020, KLA has had 4 upswings in the range of around 100% to over 300% in magnitude. The current upswing, from early to mid-2025, is already a jump of 182%, a chunky move in such a short space of time. The stock now finds itself at the top end of its historical trading channel. This stock, over the very long time frame, has been a proven compounder. I have not included a very long-run chart here, but users can inspect it in their own time if they wish. Given the momentum behind the stock at present, I think it's perfectly possible to think it could charge on and gain another 100% from here in short order. However, in order to do that, we would need to see a break with the typical historical range. I, personally, do not feel comfortable buying into a stock at the top of its range after an extended run. Readers with more of a flair for market timing than me may consider riding this momentum when it is there, watching attentively for any signs of the wheels coming off. Earnings incoming. Earnings are due out for KLA on the 29th of January after market close. Looking at the Seeking Alpha estimates, it's surprising the EPS growth forecasts aren't higher. For the coming quarter, the market is looking for just 7% EPS growth. Given the numbers we saw coming through from TSMC and their CapEx budget, I would be very surprised if KLA doesn't easily beat this EPS forecast. They have beaten estimates in 19 of the past 20 quarters, so expect more of the same. Given where the valuation is at present, my sense is they will have to deliver a pretty compelling beat on the day. Failure to do so will likely see the stock down a few percent. The valuation side is pretty extended at the moment, and indeed, in a reasonably efficient market, a valuation ought to be extended. We have heard months and years now of great news for KLAC, from the hyperscale announced CapEx to TSMC posting bumper profits and ramping up their own CapEx. These factors are an easy read across to the semi-fab equipment players. If TSMC is jacking up its spending, it doesn't take a genius to guess which companies I might spend that money with. The issue right now from an investor standpoint is the sharp elevation in KLAC's valuation suggests the market is doing a decent job of anticipating earnings to come and pricing out some of the potential upside in the process. Risks. Given I have chosen a hold thesis, I think there are both risks to the upside and downside of that call. On the upside, the risk is that the current wave of CapEx spending is only the start of a decade-long supercycle, in which case, the current upswing in the stock of roughly 180% from its recent low might be just the start. We know this is a stock that can really move when it does. In the past 5 years alone, we saw an upswing of over 330%. And that was before the CapEx cycle really hit its stride. The risk of a hold thesis is it's simply too conservative for the moment. It's relying on a sensible valuation framework in an epoch that isn't asking for one. I absolutely concede that KLA could keep going from here. If it generated another 100% return from its current level, I wouldn't be shocked at all. However, history tells us it always comes back down to earth to take a breath. It's a great company and one to own. My preference is to not get too greedy when the market is clearly ebullient. Patience is a virtue, and I intend to practice it. To those currently riding the momentum in KLAC, I wish you nothing but luck. The downside narrative to a hold call would be the stock is currently trading at a massive valuation premium. It's priced for perfection. Also, As I pointed out before, 40% of the revenue is from China, and that could be put at risk simply at a whim or as a negotiating tactic in a bigger geopolitical game over which KLA has no influence. When those factors are considered together, surely this name is a sell. The downside narrative is persuasive. The issue I see with it is a sell recommendation would suggest holders of the stock should close positions, rather than simply have new buyers sitting on the sidelines. Given the quality of this business, its place in the industry, and the momentum that it's quite clear is being experienced at present, I don't think a sell rating is warranted. It's a fine balance, but my perspective is if I held that stock at present, I wouldn't be selling out of it. But at the same time, I don't think I'd be adding to my position at the current valuation. Hopefully, that logic makes sense. Conclusion. The WFE companies have had a great run to start the year. Last week's numbers from TSMC have shown us the impact of money flowing through the semis ecosystem from the hyperscale cloud giants on down. KLA is a leading industry player with a deep moat. However, I have chosen to remain with a hold rating as I don't like the entry point at the moment. The stock has a history of strong up and down price movement, with the stock currently at the top end of its typical trading range and at a very pricey valuation. The risk-reward balance isn't where I would like it to be to initiate a buy rating. This article was written by Percy.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.